Welcome to Choosing the Right Business Entity. This video is part of the Small Business University video series. My name is Christopher Reagan, and in this video we're going to talk in depth about the different kinds of structures you can create and set up for your business. Now, before we get into that, let me say this about the Small Business University, if this is the first video that you're watching in the series. The Small Business University is about how to run your business, doing things yourself, using software and services where you don't necessarily know how to do something. But for the most part, this series is about how to do everything without having to outsource a lot. So whenever we talk about setting up a business structure, many new business owners use attorneys and use the attorneys not only to make the business entity decision, but also to set up the business entity. I'm not trying to discourage you from doing that. However, this video is going to be fairly comprehensive. I've set up hundreds of corporate structures and served hundreds of clients in my practice, and I'm going to show you exactly what I tell them. So from the standpoint of, can you watch this video and then set up your own business and make the decision yourself? I believe you can, absolutely. But I don't want to discourage you from using an attorney if you want to. And just like everything in the Small Business University, we're trying to train you on how to do all of this yourself and be a self-contained business owner, perhaps outsourcing things to a few pieces of software or services when needed, but for the most part, training you on how to do everything you need to do from setting up your business to running your business. With that, let's jump in to our first slide. There's a topic, an idea that you must understand in order to accurately figure out what business structure is right for your enterprise. And this is an idea called legal structure versus tax structure. Legal structure means the way things are set up in the eyes of the law. So there are a few different setups you can have from a legal perspective. One of them is called sole proprietorship. They're all on this line here, this green line. You've got a sole proprietorship, you've got a corporation, or you've got a limited liability company. This is what the state, depending on what state you set your new entity up in, and usually that's going to be the state you're operating and living in, this is what you would set up at the Secretary of State's office. However, there's this other idea of tax structure. And down here in the yellow, I've got the different tax entities. They're called disregarded entity, S corporation, partnership. Now, it may look confusing, but if you give me just a second, I'll explain exactly what these things mean. Basically, in many cases, legal entities can be one of these tax entities. So for instance, a sole proprietorship and a limited liability company can, in the tax world, be a disregarded entity. A corporation and a limited liability company can both be an S corporation. So we're going to talk today about both the legal status and the tax status of different entities. And what I want to make sure you do is you don't want to call a S corporation a legal entity, because actually that's a tax idea. S corporation is something the IRS assigns you. Partnership is something the IRS assigns you. Same with disregarded entity. Whereas the state assigns you the entity of sole proprietorship, corporation, and limited liability company. Now, your new structure will be one of each of these things. So your sole proprietorship, if you started a sole proprietorship, is going to be also a disregarded entity. Okay? Your limited liability company is going to be either a disregarded entity, a partnership, or an S corporation. So think of it as you're going to have one of each of these line items. And most of this video is about describing to you the advantages and disadvantages of each so that you can come up with an idea of what you want to be. I'm going to disclose here if you wanted to skip to the end of the video, Most of the time, I recommend a corporation be set up from a legal entity status that has a tax status of an S corporation. So probably 95% of my clients and 95% of the new structures I see created should in most cases be a corporation and an S corporation. However, limited liability company, you've probably heard of this, LLC. These are the very popular entities. I'm going to get into some of the details, but I'll tell you, limited liabilities are created usually 2 times more than corporations. And I think that I have no evidence to support this necessarily, but I think it's just because people like the name limited liability company better. Because it can't be because limited liability company is just a better option. Because as I said, I think a corporation from a legal perspective is just as good, if not better, in most cases as an LLC would be. But I think the name LLC just sounds cooler, and so people want an LLC. Almost, regardless of whether you set up a corporation or an LLC, I'm almost always going to want you to be an S corporation. So we're going to get into some of the details of this, of why that is. And if you have not set up your legal structure yet, you can use some of this information to do so. And if you have, you can start to say, well, do I have the right structure for my business, or do I need to do something a little bit different? So let's jump into it. First, I'm going to go over the sole proprietorship. And in the next few slides, you're going to see these 4 boxes are in each slide for each business, because it's a way to show you if they rank well or if they rank poorly in each of these categories. The 4 categories are liability risk, setup cost, operational tasks, and scalability. And let me kind of define what each of these are. Liability risk is if someone or an employee, a customer, anyone decided to sue your business, what are you going to lose if they win? So if they sue you and they win, what kind of assets and what kind of loss do you stand to incur if they prevail and you don't? And this liability risk is really a very big issue, because there are many ways people can decide to file a lawsuit against you. And if you lose, you may be at risk of losing some assets that you didn't think were maybe at risk. So that's what liability risk is. And I'm going to explain why sole proprietorship has a red box here and the liability risk is very high in a second. Setup cost is, what does it take to actually set up this entity? Is it costly? How much time does it take? How easy is it? That kind of thing. Operational tasks are the requirements or the duties that you must execute each year to keep the entity legal, to keep the entity running correctly, and how hard is it to operate one of these things. And then scalability is how does the entity help you grow your business? Is it easy to go from 10 customers to 1,000 customers? How easy is it to scale up that business? So as you can see with sole proprietor, the 2 areas that it is very bad, I guess if for lack of a better word, is in the liability risk area and the scalability area. From a liability risk perspective, this is the one where if you're a sole proprietorship or you're thinking about using a sole proprietorship, this is the one you want to make sure you absolutely understand. Because as a sole proprietor, you are at risk at any time to, if a lawsuit comes and you lose, not only are your business assets at risk, but also your personal assets are at risk. So when you're a sole proprietor, there is no difference between you and your business. It is all the same entity in the eyes of the law. So if someone sues you and they win, not only could you lose money that's in your business checking account, you could lose money that's in your personal checking account. You could lose assets that you own personally. You could lose your shirt, right? As the saying goes. This is a very risky setup. And in most cases, you should not be a sole proprietor. At least from where I sit, I do not see ever a reason why someone would actually want to operate a legitimate business as a sole proprietorship, because you could lose everything on the whim of a court or a decision. Now, the reason sole proprietorships make up, there's about 28 million small businesses in the U.S. About 17 million of those are sole proprietorships. The reason they are is because they're very easy to set up. When I say easy, it means there's zero to do. You can walk out your door right now and start working for someone. You don't have to register. You don't have to do anything. They can pay you in your name, and you are running a sole proprietorship. So it means the setup is literally nil. And that's one of the reasons the liability risk is so high, is because it is a very easy thing to set up, but it's also a very dangerous thing to be running, like I said, a legitimate business through. The same with the setup costs. The operational tasks are very low. You have to do nothing. There's no minutes, there's no meetings, there's no registrations. You can go out and get a fictitious name if you want to, and you'd have to register that usually with the Secretary of State or the business services in the state, but that does not protect you in any way. That's just a way that you can operate your business as something other than your name. And the operational tasks are nil. So these are very easy to set up, and that's why everyone's running them, is basically they just haven't taken the time to set up a legitimate corporation or LLC or some kind of entity. And from a scalability perspective, these are terrible, as you might have probably thought before you even saw this slide. They do not scale well. They do not have a separate entity that's easy to show vendors, to show lenders, to show investors, to show anyone who you need to help grow your business. This is, frankly, a terrible structure to do that in, because it becomes very confusing. Everything is on your personal tax return, and you do everything personally, and it just becomes a nightmare when you have to hire people and have lots of operational expansion. So if you haven't quite got the gist of what I'm saying right now, is if you're a sole proprietor, you need to evaluate these next structures that I'm about to show you. And if you are thinking about starting a business, probably stay away from sole proprietorship if you can. Now, the next one is the corporation. This is my favorite. So the corporation is great because one of the liability issues with the corporation is, once you set up a corporation and you're operating as this corporation, you can say that if you get sued or you have a lawsuit that comes after your business, they're coming after just the corporation. So the corporation shields you or limits your liability as it relates to your personal assets. So if you lose a case, yes, the corporation may have to pay something, but if you don't have a lot of your assets and your money in the corporation, there's nothing else to get. Whereas your personal assets, your investments, your home, your cars, your jewelry, your IRAs, all of that kind of thing is insulated from any lawsuit. So this is a great thing from a liability risk perspective, and why most major companies are corporations, is because there's a great track record of law that insulates them. See, corporations have been around for hundreds of years, and that's one of the things I'm going to bring up when we come to LLCs. LLCs haven't been around nearly as long. So corporations have a massive amount of law that shows that these are to insulate the owners from liability. Setup, I put the setup cost as moderate. And that's because it's not quite as easy as a sole proprietorship, but it is very easy to set up. There's a little bit of cost. So in most states, you're going to have to pay somewhere between $50 and up on the high end, maybe $500 to set up a corporation. These are the fees that the states charge. And then you have to fill out a form to set them up. You usually need to get an EIN number. We're going to go over all of this in the course, but nothing too strenuous. And the reason I call it moderate and not high is because on the LLC side, normally LLCs are a bit more expensive, at least in most states that I've ever set them up in. They're a bit more expensive than corporations. So really LLCs should get the setup cost high category, whereas the corporation is moderate. Operational tasks, however, are high. So with a corporation, you need to have shareholders meetings. These can be very easily done, and we're going to show you how to do them. But you do have to have shareholders meetings. You have to have minutes. You need to make sure that you are renewing the corporation each year. And so there are tasks that go along with operating a corporation. So I'd say the operational tasks are high. The scalability is very high and very good. So with a corporation, it's very easy to go from 1 customer to 1,000 customers and have the entity be able to grow with you like that. It is by far the best way to do it because of the bank accounts in the corporation name. Lending can be done in the corporation name. Investors invest in the corporation as opposed to a sole proprietorship where they need to give you the money or something. So the corporation offers you lots of scalability. Now, let's take a look at the limited liability company. Not much different from the corporation. Again, the liability risk is low, so the limited liability company has that liability shield just like the corporation does, meaning if someone sues you, it's just the LLC that is at risk of losing some assets. Now, I can tell you something, if you are a single member LLC, meaning that you are an LLC that just has one owner, there have been some situations in certain states where the person suing the LLC has been able to what we call pierce the liability veil, meaning they were able to go through the LLC and grab the assets of the owner. Again, another reason why I would say stay away from the LLC and go to the corporation. The corporation, to my knowledge, does not have any instances like that. But in most cases, the LLC will protect you just fine. Setup costs are high, as I mentioned before. The setup costs are higher usually than a corporation, so you have to pay more to set up an LLC. The operational tasks have very similar requirements as a corporation. You have to have some meetings. You have to renew them each year. There are some works that have to go into maintaining an LLC, although this should not scare you away from either an LLC or a corporation. These are very easy. We're going to show you how to do them. And then on a scalability, I put moderate instead of high. You remember the corporation was high. The reason I put the LLC as moderate, the LLC has some attributes to it that do make it a little bit harder to scale. For instance, you don't see very many LLCs go public. You see mostly corporations, and that's because there's certain things in different states with franchise taxes and the way that limited liabilities are set up from a shareholder perspective that make the corporation a better vehicle to go public with than the LLC. So I put moderate here simply to illustrate that I think the corporation has a better scalability value than the LLC does, but both of them are much better than a sole proprietorship. Now, let's kind of get into some of the tax ideas here, because we talked about sole proprietorship, corporation, and LLC. Now we're going to get into the tax side. And the first category, if you remember all the way back to the beginning, was the disregarded entity. And so the disregarded entity is basically where you are going to file your business taxes on the personal tax form. So you can see a picture of the 1040 right here. This is the personal tax return, and disregarded entity goes on something called a Schedule C, or sometimes it can go, if you're running a rental operation, go on Schedule E. If you've decided to go that route, you can also put rentals on Schedule C. But one of the things to illustrate here is both a sole proprietor and an LLC can be a disregarded entity and file here. And this is again one of the entities I do not like. I do not like disregarded entities for tax purposes because, let me give you just one example. Let's say you're at the end of your business and you're ready to sell it. And you want to sell your wonderful operations, time to get paid off. And they say, the buyer says, I need the last 3 years of tax returns. Well, you're going to have to send them the 1040, your personal tax return. Of course, this has all kinds of information that isn't pertinent to the sale of the business at all. But because the tax return is part of your personal return, you've got to send them all of this. It looks unprofessional. It can actually threaten deals because many new buyers don't want the liability of having to buy a sole proprietorship. So instead of buying your company, they're just going to buy the assets. It's very hard to do tax management for a sale like that. So again, disregarded entity is not great. But I can tell you this, the cost of the tax return work for disregarded entities very low, because the Schedule C and the personal tax return are the least expensive types of tax returns to have done. At the same time, the tax efficiency is very low. This is because a disregarded entity that files a Schedule C is subject to every kind of tax there is. So not just regular income tax, it's subject to self-employment tax. It is there's very little tax planning you can do with a sole proprietorship, and it really means that you're going to be paying the full freight of U.S. income tax returns having this kind of structure. So while the cost of the tax return may save you a few $100s, you will easily pay thousands and thousands and thousands more in taxes by having this kind of entity. So again, not my favorite. The S Corporation, on the other hand, is definitely my favorite. And you can see a picture of the S Corp tax return over here on the right. The S Corp tax return, one of the nice things about having a separate tax return for your business is if you need to show someone financials, or in that prior case that I was examining before, that you're trying to sell your business, you now can send them a business tax return that has nothing to do with your personal taxes, and they can evaluate exactly what the business has been doing. And these are really important when people are buying companies, because they know that on your bookkeeping you can inflate or show very high numbers, but they know that you're only going to show what you have to on your tax return. And most people that are buying businesses want to see, a couple of years worth of these tax returns at least. This is a very, very good thing to have, because you've separated the business from your personal and shows that you're taking a more professional approach to the management of your corporation. But at the same time, the cost of the tax return work, I put this as medium, because it is more money. The average cost of a corporate tax return in the U.S. in 2015 was about $761. So this is more expensive, because not only do you have to do this tax return, you still have to do your personal tax return. So you may end up paying $1,000 if you go to a traditional accountant. You're not using software or something. If you go to a traditional accountant to have all this done, you're going to pay probably in excess of $1,000 to have all this stuff done. However, you're going to save quite a bit of money, because the S Corporation especially is very tax efficient. Why? Not only can you have some tax deductions in a 1120S tax return that you can't have in a sole proprietorship, but also the 1120S has a very special provision, the S Corp tax return. It is not subject, the distributions to the owners are not subject to self-employment tax, which runs 15.3%. So you can save quite a bit of money. Now, there's a few caveats to that, and we're gonna jump into that in some later videos, because you do need to pay reasonable compensation to the owners, the owner officers of the S Corporation, which means you're going to pay some self-employment tax, but it's better than paying self-employment tax on everything you make, which is what happens in a partnership or a disregarded entity. So the S Corporation really, in most cases, has some of the best tax advantages that there are out there, and the tax efficiency is very, very high. Now, a partnership is, think of a partnership kind of like a disregarded entity that has two people. So I've illustrated that here. You have to have at least two people to have a partnership, right? Which kind of makes sense. That's what the name or the word partnership means too. And this file is something called a 1065. You can most of the time have an LLC that is filing as a partnership. You could actually have a corporate structure that files as a partnership too, but most of the time these are LLCs or LLPs, limited liability partnerships. The cost of the tax return work is higher. I left it as yellow because it's about the same as an S corporation, but it is higher from the standpoint of there's more basis tracking that has to be done by the tax preparer in a 1065, so they tend to be a little bit more money. Still, the main disadvantage of running a partnership tax return and having a partnership tax structure is the tax efficiency, because this is basically the same kind of tax efficiency you get with a disregarded entity, with the exception of there are some deductions you can take as a partnership that wouldn't necessarily be available as a a disregarded entity, but at the same time, you're still subject to self-employment tax on everything that you earn inside this, unless you can prove that you're not actively involved in the partnership, which is very difficult to do. So again, if you can avoid being taxed as a partnership, I would. Now, there are certain situations where being taxed as a partnership is advantageous. One of them has to do with real estate. If the partnership primarily owns real estate, and also if the partnership has several foreign investors, sometimes running a partnership is better, because as an S corporation, there are certain rules on that kind of thing, and you can't do it. With a partnership, you can have multiple classes of stock, whereas an S corporation, you can't. So in exotic situations, the partnership may be better than an S corporation. But like I said, in 95% of my practice and what I see, kind of the meat and potatoes businesses in the U.S., they are best whenever they are S corporations. So if we're making some comparisons here, the sole proprietor disregarded entity, again, easy to set up. It's on the 1040, subject to SE tax. You don't have to have corporate meetings. There's not a lot of regulation. Okay. The LLC partnership, it does have a high cost to set up. It does require a separate business tax return. It's subject to self-employment tax like the sole proprietorship. It is highly regulated. You've got to have annual corporate meetings, but it's nice. It's easier to scale. And finally, the corporation, the S corporation, definitely my recommendation. It's got a moderate cost to set up. It's not subject to self-employment tax. It does have to have annual meetings and adhere to regulation, but is very easy to scale and creates very low liability for your business. So again, it is very protecting from the standpoint of your business being sued by other people. If you need to set up a sole proprietorship, so what I want to kind of go through is what it takes to set some of this stuff up. And to set up a sole proprietorship, you're going to be setting it up in one of two ways. Either as you, which if I was setting up a sole proprietorship as me, it would be just called Christopher Reagan. And I would use my own bank account that I've been using in my life before I started the business. And literally, you can walk out the door and start working. You can also set up a fictitious name. So to set up a fictitious name, you can go to the Secretary of State's office or the Business Services website for your state and register a name with them. And that means you can open a bank account with that fictitious name. So let's say I wanted to call my business Reagan Carpets. Well, that's not my name, so I need to have a fictitious name to operate my sole proprietorship as that. So I would go and register that Reagan Carpets name with the Secretary of State, and then I could set up a bank account with Reagan's Carpets as the name of the bank account, so I could deposit checks and other things that people write out to me when they pay me as Reagan's Carpets. Again, I would not recommend this, but I put this in here so that you know how to do it. Setting up a corporation or LLC is a little bit more involved, but here's what you're going to do. So the first thing is, in most cases, you're going to set this up in your home state. You may do some reading where you see people set up corporations in Delaware. Well, the reason they set up corporations in Delaware, Nevada, or something like that is because those states have very advantageous franchise tax laws and rates. But franchise taxes are really not that big a deal to small corporations or LLCs. They're big deals to companies that are going public because they may have millions, if not billions of dollars worth of capital inside their balance sheet because they've gone public and sold all this stock. And then they may have to, if they were in a state like Missouri, they would need to pay possibly millions and millions of dollars to Missouri because of all these franchise taxes. So most cases, I would say you're going to set this up in your home state because it's easy. You can deal with your own Secretary of State. You can have your home address as your corporate address, and everything just becomes much easier. You don't need a registered agent or something like that. Most of these states allow for doing this online. So most of the time it is the Secretary of State that manages corporate setups. If you want, you can also use an attorney, of course. And then there's another company called LegalZoom. You've probably heard of it before, that does a lot of corporate setups. And you can go on their website and they'll set it up for you. You have to pay a bit more money. So, for instance, the state fee to set up a company, let's say in the state of Florida, may only be $100. But if you use a company like LegalZoom, they're probably going to charge you a few hundred more dollars to do their work, and on top of the $100 they have to send to Florida. So it does become a little bit more expensive. In most cases, you can go online and do a lot of this yourself. Corporations, when you set them up, okay, corporations are automatically taxed as something called a C corporation, okay, not an S corporation. So if you want to be an S corporation, I have this down here at the bottom. If you want to be an S corporation, you'll need to file something called a Form 2553. Just go look at it. Just Google Form 2553 and read the instructions. It should take you about 30 minutes to read the instructions and fill this thing out yourself. If not, engage an accountant or a tax service, and they can fill out a Form 2553 for you. But again, just take the time to read about it, and you'll see how easy this stuff is. It's basically filling out your name, your company's information, and some of the signature lines need to be signed, and then you fax it to the IRS. That's it. So, I mean, it is easy. But originally, corporations are going to be a C Corp, so don't just wait until the end of the year to worry about this 2553. If you set up a corporation, you want to be an S corporation. Do this within the first 75 days of your corporation being open. So do it right away. LLCs, on the other hand, are automatically, if it's just one owner, are automatically disregarded entities. If it's more than one owner, they're automatically partnerships. LLCs can be S corporations. They just need to file a 2553 too. So if you set up a corporation or an LLC and you want to be an S corporation, which is what I recommend in most cases, just go and file the 2553 as well. Before you file the 2553, however, you'll also need an EIN, an employer identification number from the IRS. The IRS issues these online. You go to a website, you fill out some information about your corporation, and they give it to you right then. You don't have to wait for a letter or something. They give it to you online right there. So you can do all of this online, make sure you write down the EIN when they give it to you, and all you really need to do is Google IRS EIN, and at the top is going to be the page to set up your EIN. Again, if you don't want to do this on your own, you can hire a tax service or an accountant to do it, but if you just read the instructions a little bit, I promise it is very, very easy. A little bit more about getting your EIN. So the IRS allows you to file this thing online, and what you do is, if you watch our video in the Small Business University, so I have a separate video about creating and setting up an EIN where I actually go online and do it step by step. Just watch that walkthrough plus read the instructions. Your EIN, the reason it's really important to get at the beginning is because it's required to get your bank account set up. So it's very easy. Just watch the video, but you have to do it to get your bank account set up. This is also what will go on your tax return. So it should be done as soon as you set up your corporation. Also, with the 2553, we have another video in the series about how to set up your 2553. And if you watch that video, you're going to see step by step how to fill it out. It's a 2-page document. Like I said, if you read the instructions, it'll only take about 10 minutes to fill out. You fax the form to the IRS, and you have to do it. You need to do it in the first 2.5 months. Okay? If you do end up missing this 2.5 month window after you've set up your corporation or your LLC, you can do a late filing using RevProc 2013-30. Now I know, now I'm in the woods, right? You're going, oh, RevProc. Now I have no idea what you're talking about. Agreed. If you end up not getting this done in time, ask your tax service, your tax software, or your accountant to help you with a RevProc 2013-30, and they can help you do it. If you don't have an accountant or a service that you're using, then query it online with Google or reach out to us at the Small Business University, and we'll give you some resources and help you find someone who can help you with that late RevProc. This is really easy. It's just it's a little bit more in the woods. I know of now you really are doing some higher level tax accounting, and you may want to get some help with that. But that's only if you do it late. If you do it in the first 2.5 months after setting up your business, and this is 2.5 months after setting up your corporation, then you'll be fine. You absolutely can watch our 2553 video and do this yourself. So that is everything that we've got in this video about business entities. Now, in later videos, you're going to see a lot more about setting up businesses, running businesses, setting up bank accounts for businesses, all of that kind of thing. So keep watching the videos, keep going, and if you have any questions, reach out to us. Otherwise, thanks for watching, and we'll see you in the next video.